following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Hello, everybody. This is Mark Longo from the Options Insider Radio Network, and I'm breaking into your regularly scheduled programming to let you know about an upcoming event that I think is going to interest quite a few of you. It's called The Future of Options Trading, Finding Edge Outside the Pit, and it's going to be held on November 5th here in Chicago. This is the inaugural conference from the Options Alliance, a new industry trade association that I am privileged to be a part of. And this conference will address the numerous issues facing the fastest growing segment of the options market, namely options entrepreneurs. So who is this event for? Well, if you're a current or former market maker and you're looking for some ways to leverage that unique skill set in some exciting new areas, well, then this event is for you. If you're an aspiring entrepreneur and you're hoping to learn a little bit more about the options market, which is the most dynamic segment of the financial marketplace, but also can be a little bit intimidating, well, then this event is for you. And if you or your firm are looking to expand the reach of your products or services by learning more about the unique needs of options entrepreneurs and new startups and new ventures, then this event is definitely for you. We've got a lot of great speakers lined up covering a wide array of topics, including how to leverage that trading and market making mindset and skill set into other unique opportunities, also overcoming the typical roadblocks and stumbling blocks that may lay in the path of a new option startup or entrepreneur, and of course, perhaps most importantly, how to promote and market that new option startup or new venture that you're planning. Now, I've been to my fair share of options conferences, so I could say with some certainty that there's never been an event quite like this. Take advantage of this unique opportunity to meet with and learn from the entrepreneurs who are out there doing it, building new businesses, starting exciting new ventures in the options market. You can learn more by surfing on over to www.optionsalliance.org and then clicking on the event sign-up tab at the bottom of the page. A lot of people say that their space is limited, but we really do mean it. So if this event interests you, reserve your seat today. Thanks for listening, and now I'll return you to your regularly scheduled program.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is the program where we take you, the raw options recruit, and we proceed to break you down through a series of brutal, quite possibly inhumane trials, and then rebuild you into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as from a little thing we like to call the old Options Insider Radio Network, the ever-expanding Options Insider Radio Network. If you haven't had a chance to check out our latest edition, the Futures Options Roundtable. I encourage you to do so right after you listen to this fine program. If many of you subscribe to our network feed, you can find it right in there. Of course, you can find it searching for Futures Options Roundtable in iTunes or Stitcher or AHA Mobile or whatever your podcast provider of choice may be. Or you can surf on over to the website, theoptionsinsider.com, and click on the tab for the new show right there and stream it directly from the site. A lot of great ways to catch up on that. If you're like many of our listeners, you're looking to add more exposure to the commodities and looking to learn how to use options to do that, and the Futures Options Roundtable is going to be a great program for that. So check it out. First episode's already up, many more to come. Futures Options Roundtable. We're really excited to finally have that one underway. And speaking of being underway, we are indeed underway on the old Bootcamp program. That means I'm being joined by my fellow drill instructor. Starting off, welcoming back the man who's been globe-trotting hither and yon, is finally back on the old Bootcamp drill instructor squad. Hat on his head, whistle in hand. He is none other than Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Oh, darn it, I am glad to be back. At ease, soldiers. Glad to be back, and we've got a great show planned for all of you today.
And a little birdie is telling me that you were traveling all over, perhaps even doing some options edumacating over there far beyond, far in those lands to the east.
Yes, indeed. We are a global enterprise here at MarketTaker.com.
All right, and also joining us, beaming in from the east, perhaps not quite that far, but still a little bit of a ways over there to the east, by way of good old New York City, he is John Critchley, the options major domo over there at SogoTrade.com. Mr. C, welcome back to the program, sir.
Hi, Mark. Hi, Dan. How's everybody? Welcome back to Dan, back from the hinterlands. Welcome to have him back. We have a great show today, my all-time favorite topic today, so I'm very excited to do some teaching.
Yeah, listeners, John's been angling for this one for quite a while, and in fact, so have many of you. Many of you have written in with questions on different variations of this theme that we're going to talk about today. So we're all very excited. In many ways, a lot of the programs we've done so far have been leading up to this point. So hopefully you've listened to all of our previous archive shows. If you haven't, surf on over, check out the archives, arm yourself with some info, because it's time to dive into Volatility Skew.
It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in. Prepare to learn. Yes, sir.
All right, everybody, welcome to the basic training segment. This is, of course, the portion of the program where we take a basic options concept, or in the case of today's topic, perhaps a little bit more advanced options concept, and we proceed to break it down for you and explain how this concept will impact your options trading going forward. And today's topic is volatility skew, as I mentioned, and this is the one that really we could spend several episodes on and not even really scratch the surface. So we're going to do our level-headed best to try to squeeze it all into one episode and give you really the salient points, the takeaways you need to know to understand volatility skew. But before we do that, I think we're going to even take a step back a little further, delve into something we touched on an earlier episode. If you want to learn more, check out our archived episode about volatility. But it is important, before we start diving into volatility skew itself, talk a little bit about volatility and what we mean when we're talking about that. Now, we talked about Vega and the Greeks' version of volatility on previous episodes. That is, of course, the measure of an option's sensitivity to volatility. So as the volatility changes, how that option's price is going to change. But of course, the volatility itself is a little bit of a different beast. And there's typically two versions, two variations, two flavors of volatility that we like to talk about in the options business. There's implied and there's historical. Mr. Passarelli, why don't you run our listeners through the differences between those two very, very important flavors of volatility?
Implied and historical. I thought you were going to say implied and spumoni.
Yes, that's my other favorite flavor. I was going to get to that on the behind the scenes maybe episode, the after dark episode of Bootcamp. We'll get into spumoni and all kinds of other fun stuff that aren't suitable for the show proper.
Right. Yeah, volatility that's one of those things that really trips up the newbie trader. And volatility is reasonably simple. What confuses people in volatility is when they start reading books and learning about volatility, because a lot of times it's not explained well in books. We'll break it down really simple. Historical volatility is kind of the volatility that you think about that comes intuitively to you. It's how much an underlying stock has moved around lately. When you say, hey, this has been a volatile stock, that's historical volatility. That's what you mean. But it's just simply measured with the unit being annualized standard deviation. And then implied volatility, that's the tricky one. That's the one where if you read a textbook on options, you end up being somewhat more confused than you started. Here's a better definition than what you read in most textbooks. Implied volatility is simply how cheap or expensive options are. The concept is, there's a number of things that affect the value of an option. There's how much the underlying stock price moves. If it goes up, calls gain value, and if it goes down, calls lose value, and vice versa for puts. As time passes, options get worth less. But both of those two things independent, there's one more thing, implied volatility, that makes options more or less valuable. So like if you have a call, if the underlying stock doesn't move at all and time doesn't pass, like in the same day, a minute later an option can actually get worth more or worth less even if the stock doesn't move. That's implied volatility, and it's really rooted in being the supply and demand, if you will, for options. When people expect future volatility, they're more apt to buy options to hedge. Well, that makes options more expensive. When you look at a chart of an option and the thing hasn't moved more than 3% in the last 10 years, nobody's buying puts to protect that. If anything, they're doing things like iron condors and credit spreads and covered calls, and they're basically selling options to try and generate income, and that drives the price lower. So that's kind of it in a nutshell. That's the demystification, if you will, of the two types of volatility.
The one thing I wanted just to add briefly is, and Dan gave a great summary of implied volatility, but we get asked all the time, and what does the implied volatility number mean, or where does it come from? I look on the chart or on the chain, I see implied volatility is 32. What does that mean? What does that mean to the average trader, or even to the pro traders? Basically, what that means is, to calculate volatility over a time period, for example, 1 month, all you need to do is measure the daily price changes, in the index or the underlying, and then calculate the standard deviation of those price changes. Okay. Next, I'm going to a little bit of math here, but next, you can multiply the standard deviation, and this is really important, by the square root of the number of trading days in a year. And if you do that, you're going to come up with a number of 15.87, basically 16. So once we get that number, okay, remember the rule of 16. And if you see volatility at 32, that's implying that the marketplace is pricing in basically a 2% move in the underlying per day. If you see a number of 16, that's 1%. So when you see those numbers up there and you see 16 or 32 or 48, whatever number it is, divided by 16, and that will give you what the market is expecting the underlying to move over a particular period of time.
Implied vol, historical vol / realized vol, these two very important flavors of volatility. Thanks for those rundowns, guys, and listeners. You can just break it down a number of different ways in your head, but basically, historical / realized. That's another term that people like to throw around for historical vol. Historical and realized, they're interchangeable terms. Realized maybe sometimes a little bit more opaque to newcomers, so we like to use historical, but essentially it's just the actual vol that the name is exhibiting. Implied is essentially the options market's best guess. You can really look at it that way. I also like to refer to implied volatility quite often as kind of the options market's fudge factor, because all the other components of an options price, like carrying costs, interest, all that stuff, they're all relatively fixed. But you see options can vary widely in price, even amongst individual market makers and other firms who have different viewpoints on the marketplace. And that all comes down to volatility. Volatility is that fudge factor, the implied volatility in the name. That's what causes an option to change radically in price with no change in the underlying, and all the other things that make a lot of newcomers to options scratch their head and say, what the heck is going on? That is all implied vol. If you want to learn more about vol, implied vol, all that stuff, I encourage you to check out our archived episode of this program where we delve more into that topic. But there we go. We have the base covered yet again. Now, what we're going to talk about today is a next level conversation. We're talking about volatility. It's volatility skew. Now, what do we mean by volatility skew? Well, it's very simple. When you look at an options chain, you have the at-the-money strike. That is, of course, where the underlying is trading right now. Then you have the strikes above the at-the-money strike, and the other strikes below the at-the-money strike. Now, in options parlance, those are typically referred to with the strikes above the at-the-money strike being called the call wing. And it's quite simple, really, because when you look at strikes above the at-the-money strike, most of the options people trade are calls because they're cheaper, they're easier to trade. All the puts in that strike and that wing, obviously, they're there. There are puts in the call wing as well. That's a little confusing to people, but those are in the money. They're usually very expensive, very close to 100 delta options, so they don't trade as much. So for most common uses and most common analysis, people are looking at the calls on that part of the option chain because that's what really trades. That's where the activity is. That's where the interest is. Same thing to the downside. We're looking at the put wing because to the downside, most people are trading puts. The puts are out of the money. They're cheaper. There's more activity there. That's kind of what's really gauging a lot of the sentiment and interest, not these 100 delta or close to in the money calls that are floating around out there that no one's really trading. So when we're looking at strikes above the at-the-money strike, we call it the call wing. Looking at strikes below the at-the-money strike, we're calling it the put wing. So with that in mind, when we're talking about skew, what we're really talking about is comparing the levels of implied volatility on the call wing versus the put wing to give you some idea for the sentiment in that particular underlying. Now, what we have in the world of most of the products that you guys are going to be trading, your equity options, your index options, and a lot of the other products that are out there is what's called investment skew. And what that really means is essentially what you're going to see are decreasing levels of implied volatility as you move up the call wing, get farther away, farther above the at-the-money strike, and vice versa. You're going to see increasing levels of volatility as you get below the at-the-money strike into the put wing. So that's what we're typically talking about when we're talking about volatility skew for the context of this show. That is investment skew. There are other types of skew. Commodities exhibit different types of skew because the fear is to the upside, so the volatility increases to the upside. You have some products that have all kinds of different types of skew. But for most of the products we're talking about here, we're looking at investment skew. And so what does that look like? Well, on a chart, on a typical graph, you may have seen this floating around. People refer to it, at least they used to refer to it as the volatility smile, but it's not a smile because it's not a symmetric graph. What it actually is a downward sloping line. So if you were to chart, let's say volatility on the y-axis and on the x-axis are the strikes moving up from left to right, what you'd see is on the lower strikes, you'd see a higher level of volatility. That is the implied volatility levels of the put wing. And they're usually bid up and they're very inflated. And as you get higher up the strike chain, as you pass the at-the-money strike and get into the call wing, you start to see that implied volatility level decrease. And so what you have is this general downward sloping line. And that's typically what we're referring to when we're talking about volatility skew on this show. It's that investment skew. And that is what you need to keep in mind when you're doing a lot of your options trading, a lot of the strategies that we've touched on this show. Dan or John, anything you want to add on investment skew before I keep rolling?
I mean, I can just somewhat paraphrase, but maybe adding something new. The idea is just think about what options are used for. I mean, people buy puts to protect investments, right? It's a variable insurance policy. So just the natural utility of puts is people buy them. And then calls, think about the first strategy you ever learned. It's probably a covered call. Very common, very investment-oriented strategy. And, a lot of the time that's really what people do is they sell calls as Well, generally as part of covered calls. So you just kind of have this natural buying the put wing, as Mark said, and selling the call wing.
Can I just add one thing? And Dan stole my thunder there, but there's a second reason why volatility skew exists, and Dan's 100% right. It's a covered calls, and therefore the calls are lower. Demand for puts creates a higher implied volatility for the out-of-money puts. But the second reason is that the market normally moves much faster down than it moves up. So the bear markets that happen, they're usually much more abrupt and more devastating than the bull markets. Bull markets are usually slower, and that makes the out-of-money puts, more desirable for protection. There's much more of a downside risk perceived than upside risk in the marketplace. So very rarely we see 8% or 5%, but during a crash it could go down even more than that. So that's another reason why the out-of-money puts are higher than the out-of-money calls.
Yeah, what Dan and John hit on the real two primary causes, because there are two causes. We get this question all the time at Insider. I'm sure, Dan, you guys get this from your mentees, and John from your clients as well. That why does this exist? What causes skew? And a skew is actually a relatively recent phenomenon. It's probably only about the last about 25 years or so that we've actually started really having a handle on skew. Before that, we had options were just priced as your typical smile and or some other alternative ideas and methods out there. But really, it was a very, very, very basic understanding of how volatility performed in the marketplace until the crash of 1987. Then people started looking at some of these puts and how they were performing, and they said, wait a minute, this isn't shaping up the way our graphs and our charts were telling us it was going to. Perhaps there's something else at work here, and that's really what caused the starting to analyze and understand skew. It's really just an observed phenomenon of the marketplace. And there are two factors really driving this. Then Dan and John both outlined them. Really, you have the psychological and you have the fundamental. The psychological impact really is that the bulk of investors, the bulk of people in the marketplace, are usually bullish, or they have a bullish bias. So when the market rallies, in general, we see this general enthusiasm, this general lack of concern, and to the downside, we see this increase of concern, increase of worry, which usually tends to translate into increased and decreased levels of volatility. And then, of course, we have the fundamental characteristics of the options market, which bear this out and help create this volatility, this investment skew that we have in the marketplace right now as well. And that is that the bulk of the trading in the call wing is, particularly from the large institutional customers, is selling. A lot of the retail as well. People are selling calls many more times than they are buying them. And what happens there, just pure supply and demand. Big mutual fund comes in. Let's say they have 1 million shares of XYZ. They want to write a bunch of covered calls on that, out of the money covered calls. That's going to depress that call wing a little bit. Another big fund comes in, does the same thing, and pretty soon, one after another, it's going to start squeezing all of the implied volatility, all of the vol juice out of that call wing, and it's going to start deflating those levels. At the same point, these people are bullish and they're also long the underlying. They want to protect that underlying, so they're going to buy puts. And that usually has the opposite effect in the put wing. It tends to inflate the levels of implied volatility we see in the put wing. And so over time, if a lot of funds are coming in and selling calls and buying puts, setting up essentially collars, like we talked about on our previous episodes, that is going to have that effect of tightening up or steepening that skew. And what kind of skew, how steep it is, it really depends and varies product by product. It's one of the first things we really recommend to traders when they're starting to trading options on a new underlying, and usually they're relatively sophisticated, so they're implementing some strategies that will be impacted by skew. We start to tell them, hey, look at the paper flow out there and look at the skew and how that really performs and what type of skew you have in your product. It's going to be investment skew, but that's pretty much par for the course across all equity and index options. But the steepness, the slope of that skew is going to vary by product. And that all is driven by paper flow. And what typically tends to happen is the larger, more widely held large cap names tend to have a preponderance of funds that hold them that are writing calls and buying puts. What you typically tend to see is a scenario where the puts are very, very bid up and the calls are aggressively sold. So you actually have a little bit of a flatter type skew. And some of the other names, you might see different types, different styles. You may see just a lot of paper flow in the put wing, so that bids up the puts, or vice versa in the calls. You could see different things in different names. So it really pays to study and look at the skew and what you have in your individual underlying. And you might be asking now, how do I gauge that? How do I measure that? The typical tool that people use to evaluate the skew in a given product is a risk reversal. And it's a very specific risk reversal. It's usually a 50 delta net risk reversal, but a 25 delta call. So you're looking at a call that's about halfway or so up the call wing, and a 25 delta put, which is about halfway or so down the put wing. And that's going to, you look at the implied volatility levels of each, you compare the implied volatility level of the call to the put, and the severity, the difference there is going to show you how steep that skew really is. And that's really kind of the main tool, the main mechanism that people use to evaluate skew in a particular underlying. Now, Dan, we talked about risk reversals here on this show in the past. Do you do a lot of those with your mentees, with your clients when they come to you? You sit down and say, hey, let's look at this 50 delta risk reversal in this name and see what kind of skew we have going on out there. Is that a step you might take with some of your more advanced clients?
Yeah, that's something we talk about, and I mean, I talk about it really on both ends. I mean, I talk about it as the collar for investors, where they're, arguably on the wrong side of the skew, but it has its uses in protecting portfolios. And then for some of the more savvy, and I won't even say investors, definitely not investors, but the more savvy traders that I teach, who are pretty well capitalized and are able to take advantage of things like the volatility shifts in the skew. Yeah, that's definitely something I talk about with them.
And just a quick note too on usage. Typically, when we're talking about skew, you might hear people saying, "Oh, I'm buying skew" or "I'm selling skew." Usually, that tends to refer to what they're doing in the put wing, and that tends to reflect the trade. So, for example, we talked about risk reversals before on this show. Usually, it means buying a put or selling a call, or vice versa, buying out of the money call, selling out of the money put. Now that you're starting to understand skew a little more, you can see why that's called a risk reversal. You're literally reversing your skew risk, your skew position in that particular underlying. And what people tend to do is, if you're buying put, selling call, you're typically buying skew. And if you're selling put, buying call, you're typically selling skew. But that's not a universal convention, but I think most traders will go by that. So if you hear that out there, I'm buying skew, I'm selling skew, or that's what the customer is doing, that's typically what they're referring to. Now, John, maybe we'll toss this one to you because this is, since the dawn of Options Insider, since the dawn of this network, we've had one question that has come in more than any other. I'm sure you get this all the time at Sogo Trade, and Dan, I'm sure you know where I'm going already, and you're really champing the bit to answer this one as well. But this one question that is the king of them all is, someone comes to Insider and they say, hey, I like this particular underlying XYZ stock. I bought a call on that, typically an out-of-the-money call. The underlying rallied. It went my way. So I was very excited. I thought I was going to make all this money. Then I looked at my option, and it was actually down in value. It had lost value even though the underlying rallied. Why is that? That's just the number one question we still get to this day. Mr. Critchley, why don't you walk us through that question and how skew is really impactful there?
Yeah, I would love to. I think we actually touched on it a little earlier in the show, but the reason for this phenomena is very simple and straightforward. Normally, as Mark, I think, mentioned, or Dan, as a stock rises, a common strategy that is extremely popular with institutions and public customers is to overwrite or sell the options against their underlying positions. Remember, most customers, most of the investing universe is long equities. So what happens is the basic theory of supply and demand kicks in, and this drives the prices lower as the market makers or liquidity providers, they lower the price of the option as supply increases. The marketplace is a supply and demand marketplace. So as the stock rises and you get more people selling these options, they're going to go lower, and that's going to crush the implied volatility. And what's going to happen also is now the out-of-the-money puts, are going to actually sometimes go higher because now they're actually in real dollar terms cheaper. So if the option had a 30 delta put option and then the stock rallies a lot. Well, now the option has a 15 delta, but guess what? The price is lower, so the implied volatility may go higher. So that we get that question all the time, and it's one of the things we've touched on in the earlier episodes as a rookie mistake or something to be aware of before you buy a lot of out-of-the-money calls.
And Dan, you must get this question probably even more maybe than we do here at Insider. People coming to you saying, help me mentor Dan. I bought a call and the underlying rallied and I lost money. And you must love this question because it hits on so many things in your wheelhouse. It gets into the Greeks. It gets into vol. So what do you typically tell your mentees when they come to you wringing their hands and tearing out their hair and saying, why did my call lose money?
What I say out loud or what I say in my head? What I say in my head is
this is a family show, so we have to keep it to what we say out loud.
Yeah, because you don't understand options. No, I don't really say that. I'm actually very nice, even inside my head, as far as you know. I'll tell you what, if I had a nickel for every time I got that question, I'd have a lot of nickels. I'll tell you that. I used to work at the CBOE. I was a market maker down in the CBOE for a long time, and then afterwards I helped out there in education, working for the exchange proper, and I would get this phone call 3 times a week, especially during earnings season, and the phone call would always start out the same. Hello, is this CBOE? What's going on over there? Your market makers are ripping me off. I bought calls the day before earnings, and the stock rallied 5%, and my calls lost money. What's going on over there? And it was just like, the first couple times I feel this question, it's like, oh, geez, sorry, sir, let me try and help explain this to you. And then it was just like, for God's sake, man, you shouldn't trade options if you don't understand them. Sorry, I'm a little cantankerous. Must be the jet lag. Everyone needs to understand volatility is a real deal concern. Just because you don't look at it doesn't mean it's not there. I'll tell you a story. This is probably close to 5 years ago in the bond option. So, maybe this is a good time to plug your new futures option show here, Mark, because we're talking futures options in this example, but it's one of the most extreme examples I can give you. There was a very large market making firm in the bond options who, I forget if they actually went out of business or came incredibly close to going out of business because of Skew. I think they actually went out of business. They were completely flat deltas. So for those of you guys who understand the Greeks, that means had really no directional risk on. They had no time decay risk. They had no gamma risk. By all accounts, it looked like they had a completely flat and riskless position. But one day they lost, I forget what it was, $10 million or something like that. And, the new traders and even market makers have to learn these lessons as well. The newer market makers are like, holy crap, what just happened here? I had this totally flat position. I got no risk, no delta gamma, no theta, no vega, no nothing. What the heck happened? How did I lose $10 million? And it was because of Skew, because they had the Skew on, and the Skew can change. We've talked thus far in this show about just the existence of Skew, but Skew is a very real risk to traders. Now, for a very huge market-making firm, it's a risk that can make or break you. You can lose millions and millions and millions of dollars if you're not careful, and of course you can make it too if you're on the right side of it. But even for individual retail traders, people who are listening to this show, Skew is very, very relevant as well. And you do make or lose money every day on Skew in your positions. So it's something you really need to watch.
Yeah, I think for a lot of our listeners, the way Skew will kind of come home for them in the most obvious way is collars. A lot of our listeners are out there using collars. They're long equity traders, and they're typically want to hedge and protect a position, so they're going to buy an out-of-the-money put. They're going to sell an out-of-the-money call. And that is typically, when you do trades like that, trades that involve both the put wing and the call wing, they're spreads that are typically verticals that are spanning the at-the-money strike in some way. That's when you're going to really start being impacted by Skew. It can happen with deep verticals from the at-the-money strike to out-of-money strike as well, but typically you're going to see a lot of that when you're doing things like risk reversals and or strangles, and also the collar. So let's say you're in a name, you're long underlying in in XYZ, and this is the name that has pretty much a very pronounced volatility skew, which means the puts have a very, very high degree of implied volatility premium baked into them. That means those puts to buy are going to be very expensive. At the same time, you're going to have a call wing that is very depressed because there's a pronounced amount of call selling, covered call selling typically in that call wing. So what you're going to have is a collar that is going to be much more expensive for you than in another name where the skew is a little bit flatter or less pronounced. So when you're looking at underlyings and how you want to collar them or set up risk reversals in them, skew is going to be a very big factor in that. It's going to dictate how much money you receive for the collar over how much money you pay for the collar overall. Maybe in a name that's a little bit flatter, you can actually get a collar off for that zero cost collar that everyone seems to be striving for. That could be viable in a name with a skew that is a little bit more amenable to it. Whereas if you have a different skew, perhaps a deeper skew where the puts are very expensive, the calls are very depressed, it's going to be very hard to get that zero cost collar. And also you could have a position on, let's say you have a collar on, and as Dan mentioned, skew is its own risk in and of itself, and it's its own variable. Everyone thinks of, well, I'm just going to think of if the volatility changes, or I'm going to think of if the underlying moves, or if the time to expiration as that ticks away, how that impacts my options position. But skew is its own phenomenon, and it can move independent of what the underlying is doing. It's all based very much on paper flow. You can have an underlying that is sitting there and doing nothing. And so from a vol perspective, not much is really happening, but you could have a risk reversal on or a collar on. Maybe you're a long put, short call. And now you have, all of a sudden, you have a position or a paper flow coming into that product where institutional traders are buying a lot out of the money calls and they're selling a lot out of the money puts. They're kind of taking that opposite position of that collar, they're taking that bullish risk reversal selling put buying call. What's going to happen if that happens quite a bit, irrespective of everything else going on in the underlying, it's going to take that skew and depress the put wing and inflate the call wing. And for you, being the collar owner on that underlying, it's not going to look very good for you because it's going to make that collar not exactly perform up to snuff, not exactly be priced the way you want to do it. That put that you're long is now being depressed from a volatility perspective. That call that you're short is now being inflated from a volatility perspective. And that's all irrespective of what else is going on in the underlying. It really is a let's see, where was I going on with that? So that all is just regardless of what else is happening in the rest of the underlying. It really is its own risk factor, its own phenomenon. It's something to be aware of as you're starting to trade more deep verticals or some of these collars and risk reversals, things that tend to span the option chain much more than just if you're going out and buying single name options. Obviously, that can impact you too, as we outlined in the out of the money call example. But in general, when you're looking at things like collars, the skew is very important. One more thing before we kind of wrap up here on our kind of skew overview. You might be looking at, well, see, how can I quantify this? How can I look at different ways that skew is quantified? There's a lot of different metrics, and there aren't that many products out there that actually quantify skew. There's one I could think of. Jan mentioned the SIBO earlier. They launched a couple of years ago now, I believe, a CBOE skew index. So you can search for that and go to the microsite page on the CBOE. That one's a little bit confusing. They use kind of a weird numerical convention to quote the skew. But what that will do is give you an idea of how the skew is shaping up in the S&P 500, in their SPX options. And as that skew, as the underlying moves, as volatility changes, you could see how that is reflected in that skew number. And that could be a good way to start wrapping your heads around some of these concepts that we're talking about today. So a lot of important stuff that really is worth hitting on here for volatility skew. Like I said, we could go on for many episodes about vol skew. Maybe we'll wrap up with a couple of quick things. John, I know you wanted to touch on term structure. So maybe we'll take a few seconds now for you to walk our listeners through that concept as well.
Yeah, volatility term structure, basically it's a relationship between implied volatilities and the time to expiration. It's really it provides another method for traders or the retail customers to to gauge cheaper or very fat or expensive options. This is actually really almost a trick question, but which expiration cycles are more alike? The front month and the next month out, or the weeklies, or the next month out and a cycle a year from now, okay? And if you ask that question to a lot of traders, they're probably going to get it wrong, because the answer is the latter, not the former. Okay? I mean, and the bottom line is that it's understanding how the implied volatilities of the months are interrelated. And it's actually a pretty, complicated, idea. So when I get questions on it, yeah, I know I'm talking to someone who's a little more advanced, but basically it's a relationship between the implied volatilities and the time to expiration. Maybe Dan can hit it on too, and maybe has a clearer or simpler way to explain it to our listeners.
Yeah, so think of implied volatility term structure as kind of a whip, if you will. That's kind of how I can sort of visualize implied volatility moving. If you're holding the fat end of a whip and you kind of give your wrist just a little, 3-inch up and down really quick, the part you're holding moves just sort of a little bit, but the far end, the little end, that can move a whole bunch, 4 feet up and, crack against each other, right? That's kind of what it's like when volatility changes. The leaps, the far out options that have a long time until expiration, their volatility tends to not really change at all. That's sort of the part of the whip that the lion tamer, if you will, is holding. But the short-term options, the weeklies, and maybe even the 1-month options, but especially the weeklies for those that have weeklies, those implied volatilities, those are the little end of the whip, the tip. They can really go up and down greatly when implied volatility changes.
Think of term structure. We talked about volatility skew, and that's what we're focusing on for today's episode. That is what we're seeing, the map of the implied volatility across the vertical options chain of a single month. Term structure is something some people will often erroneously refer to this as skew as well. You can think of it maybe, I guess if you want to, as time skew, I suppose. That's really just a map of the at-the-money implied volatilities across the different months. So if you have January and February and March, and then December in a typical expiration cycle, let's say, then of an option, then you might see here the at-the-money in January is 35 vol, the at-the-money vol in February is 40, the at-the-money vol in March is 32, and then maybe December you have 50 for some very strange kind of sloping term structure there. And that's kind of what you're looking at across months, but that doesn't break down the skew of the individual month. It really is kind of just a starting point for when you're looking to do things like we talked about in the earlier episodes, like calendar spreads, then the term structure will come into play. But I think more about that on another episode. I just wanted to touch on it now, because some people will mistakenly refer to that as skew sometimes, when really what we're talking about in skew is in an individual month, an individual expiration month, and how that implied volatility level changes across the options chain. Now, Dan, like I said, we're going to try to squeeze it all into one episode. I think we did a decent job of hitting on the salient points. Anything you want to leave our listeners with? Any takeaways on skew, how it can impact their trading, how they could use it to their advantage? What should they walk away from this episode knowing about skew?
On every single trade that you make in options, you either make or lose money based on skew. So you can choose to just have it be a wild card risk and, just be loosey-goosey and figure, I'll make or lose some money and I won't know why and I won't pay attention to it. Not very responsible. Or you can choose to put it to your advantage. And all my traders who are my students, I teach them how to use it to their advantage. Things like vertical spreads, butterflies, iron condors, and things like that. Any spread that has more than one strike, you can choose to put skew on your side and in your favor. As far as term structure of volatility, arguably, I guess we can call that time skew, if you will. Use that all the time. I teach my students who trade time spreads how to use volatility on every time spread trade they make to give themselves a statistical advantage. And, ultimately that's what trading's all about. It's a statistical game. It's a game of chance, but the people who win put the odds in their favor, and that's what you can do with skew.
Well said, Mr. P. Mr. C, what do you want to leave our listeners with about skew here?
Yeah, 2 very quick things, and Dan hit on one of them. How to use skew to your advantage. The one way that I personally use it is that if I like to do call spreads, and let's say you like to do call spreads, if you're putting on a vertical, so you're buying, let's say, the out of money, selling the out of money, if you see that the implied volatilities line up or are pretty close, that may be an indication that's a pretty good spread, because the out of money calls should be much lower or much lower. So that's one way. The second way that I love to trade is, and we haven't really touched on it, but I'll quickly touch on it, reverse skew. And what does that mean? Reverse skew is when the demand for the upside calls becomes so great that the skew bends for the out-of-money calls, and that the out-of-money calls become very, very expensive. Boy, oh boy. When I see that, that's an indication to me that there's some speculative call buying, a takeover rumor, or sometimes a company where the upside risk is perceived to be as great as the downside, like a solar company or a biotech company with a drug announcement. So reverse skew is a big green light for me in general, and it makes me very comfortable when I see out-of-money options trading very, very fat. Somebody either thinks they know something or they do know something, and that may be smart money that thinks that. So that's usually a green light for me.
Yes, that phenomenon you're talking about, that reverse skew there, we see that quite a bit. It used to happen quite a bit in Apple. Prior to earnings, the zealots would flock in and bid up the out-of-the-money calls, that call wing, and give inflated levels of implied volatility to that call wing, to the point where if you wanted to do a vertical call spread, buy the out-of-the-money, sell the out-of-the-money, you could do it for a much more favorable price than you could in any other environment. We're starting to see shades of that now popping up in Facebook. So a lot of our listeners out there are certainly watchers of Facebook. They use Facebook, they trade the stock. So if you're thinking about a place that you can maybe leg into some call verticals for some favorable levels, then Facebook may be a good opportunity for you. All right, that's all the time we have for our basic training segment for today. Now we're going to keep on rolling right on into my favorite part of the show, because it's your part of the show. This is, of course, the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call segment. And we have a very timely question here to kick things off from Mr. Nick D. And he writes, I'm a covered call seller. I've heard some people recommend that I should sell in the money covered calls instead of my usual 5 to 10% out of the money covered calls because of volatility. But why would I want to sell a call that is going to inevitably be called away? What is your thought on this strategy? Well, Nick, interesting question. And actually, like I said, it is very timely because we are talking about skew today. And so this is exactly what we're talking about here. The reasons that a lot of the reason that a lot of covered call newsletters and covered call services and covered call devotees in general have started migrating some of their liquidity down into those in-the-money call strikes is for exactly some of the reasons we outlined today. And we talked about how the put wing in general has an inflated level of implied volatility versus the call wing. So if you're repeatedly writing out-of-the-money covered calls, which is the way most people do covered calls, you're usually getting less bang for your buck from an implied volatility perspective. You're selling a lower level of implied volatility. And in this environment, a lot of environments where volatility has somewhat trended down of late, of course, the last few weeks notwithstanding, then it becomes more difficult to find premium levels that are worth selling, that are worth writing the covered call on. So what we've seen, some people who are knowledgeable of skew and understand how that effect works are starting to say, wait a minute, why don't I take advantage of that implied volatility pop in the put wing and start writing some in the money covered calls? And it depends what you're looking at, how far in the money you go. Usually they're somewhat near in the money, so maybe 70, 75 delta calls. You're not usually talking 100 delta calls very deep, because those have a lot of other things that you're writing as well as just the volatility premium. But somewhere right in the middle of that put wing we're talking about now, that is where they like to write those in the money calls. So take advantage of that. Of course, a couple of downsides to that. One of them, what you just pointed out, that option is usually very, very in the money, so it's close to 100 delta, so it has a much higher probability of being called away. Now, that's not typically a downside. That's something we've said many times on this show is fine. If your underlying is being called away because you're writing covered calls, that usually means you're doing something right. So that's not something to be worrying about like you seem to be doing here. Having your underlying called away, not a bad thing. You just have to wonder if what you're writing that call for is worth it. And of course, remember, We talked about synthetics on an earlier episode. When you're writing an in-the-money covered call, you're essentially just writing a naked short put on that strike. So think about it that way. Would you say to yourself, would I write this naked short put on this strike right now? And if you would, then that's probably a better way to go, maybe even than the covered call, because you're not tying up the capital, you're not tying up all the margin requirements and everything else that goes into, all the capital that goes into creating a covered call position and then writing the in-the-money call on it. You can just write the puts. If you're worried about downside, you can write a put spread instead, and maybe do it that way in a little bit more capital efficient way. Then you don't have to worry about as much of the selling the in-the-money call, having it called away, that sort of thing. Now, Dan, I know a lot of your clients over there like covered calls. Are you seeing any of them adopting this approach, or are you counseling them for or against it? What's your take here on the strategy Mr. Nick D outlined?
Really, what it all comes down to is what your objective is. I mean, there's never a one-size-fits-all answer to, is this option strategy better than this option strategy? If you bought a stock, if you bought Apple 15 years ago at $4 or something like that, you might not want that stock to get called away for tax reasons. I mean, I'm not a tax expert. Talk to your tax advisor, but I mean, that's, kind of straightforward. If you don't, sometimes you don't want a stock to get called away for tax reasons or maybe for some other reasons. But like Mark said, a lot of the time you do. I mean, if you're more of a trader, and you're just owning the stock and you just want to take a profit on the stock, why not? Selling an in-the-money call gives you the advantage of more expensive time premium, and that's another thing you need to look at. Don't look at the intrinsic value, that in-the-money value, that there's no volatility on that. It's only on the time premium. So not a one-size-fits-all answer. This is kind of one of the things that I go over with my one-on-one coaching students, especially the people who have larger investment portfolios and really need to understand this stuff pretty well. But selling in the money calls is definitely a viable strategy under the right circumstances.
Yeah, so great question, Mr. Nick D. Very timely, actually. I like when that works out because we're talking about Skew today, and this is a question, another example of how Skew can impact your own trading. If you're looking at ways to juice up your covered call returns a little bit, this might be a strategy you'd want to consider. All right, and next up we have a question from Charles Midler from scenic and sunny Santa Fe, New Mexico, and he writes, I'm thinking about hedging my short stock positions with short put positions. How do the drill instructors view this strategy? Am I on the right track? Can John discuss the margin requirements of such a strategy? And John, since he names you in his question, I think I'll toss it to you first. First off, what's your take on doing this, on writing the short put against the short stock position, and then walk us through some of the margin pros and cons of this?
Sure. This is a covered put trade, and it's the exact opposite of the covered call, except when you put this trade on, you have unlimited risk. The stock can theoretically go to infinity and beyond. As far as
you have a Buzz Lightyear fan around your house too, as well.
Yeah, exactly. I got little kids. There's no margin required on the short puts, and the margin requirement on the stock is 50% of the underlying. Now, this is the really key point. Remember, we keep going back in almost every show to our synthetic episode, whatever number that was. I don't remember, but this is the same as synthetically naked call writing. And I would prefer a customer, if they have the money in their account and their approval, just to do that, because the naked call writing is going to eat up less money. The margin requirements there will be 20% of the underlying minus any out of the money amount. So, and it would be better for them, and it'd be actually cheaper commission-wise for them. So, a customer-friendly way, I prefer that they just sell some naked calls versus doing a covered put strategy.
Yeah, you're right, John. This is an interesting strategy. People need to be aware. Obviously, the synthetics, I looked it up as we were talking, since we referred to it so many times on the show. It was episode 18 that came out back on March 6th. So if you want to review our synthetics conversation, check out that episode. You can find it in the archives on the optionsinsider.com or in the archives on iTunes or wherever you get this fine program. And you're right, John. People should be cognizant of what they're doing there from a synthetics perspective. And they should also just think in terms of raw delta, if that helps you as well. Depending on what put you're writing, that will show you how much protection, quote unquote, you're actually getting, how much hedge you're putting on. Remember, this is not a true hedge in the truest sense of the word, because when you're talking short stock, the risk is to the upside. And when you're writing short puts, it's not going to cover you to the upside for very long. So unless you're writing very, very in-the-money puts, and what we see a lot of times with this strategy is people will wait until the short stock has gone their way for quite a while, and then maybe they'll write a nice, meaty in-the-money put to quasi-lock that in. Obviously, if the underlying rallies, they're not going to keep all of that, but they'll keep a portion of that. And that's usually how we see these strategies being implemented. Remember, we talked earlier on the show as well about things like delta neutral strategies. You can remember your delta equivalency when you're doing this. If you have a 50 delta option versus a 100 delta option, how many options you need to write and how much delta you're getting from that versus the underlying itself, and how much hedging value you're actually getting out of this strategy. So it's a good strategy. It can work. Just be cognizant of all the things that we've outlined here, your synthetics. And remember the delta. If you have a stock that's dropping and dropping and dropping and you're writing some 10 delta out of the money puts, I wouldn't really consider that any sort of hedge. If the stock drops past that strike and expires there, yeah, you're gonna be locked out of that strike, but I wouldn't consider that a hedge. So keep that in mind when you're thinking about this strategy. Maybe one last quick question here. This one comes in from Nomad6. Since you're the former SIBO Options Institute guy, Dan, this one has you written all over it. And Mr. Nomad6 writes, what are flex options? Mr. Passarelli, take us through flex options and what you can use them for.
So options that are listed on an exchange like the SIBO or ICE or whatever, they're all standardized. They all basically represent the rights on 100 shares. They all expire on the Saturday following the third Friday of the month. They all have uniform strikes that are either at $1 or $5 or $2.50 increments. It's all very standard and makes it easy for people to trade because you kind of know what to expect. You know when expiration is, blah, blah, blah. But what if you're a big institutional investor and you're worried about a risk that is, some announcement that is expected on Wednesday, or you want to get out of your stock at $32.17 and you'd love to sell a call at that oddball strike? Well, you can do that with flex options. Flex option is flexible. You can change those standardized contract specifications to whatever you want. Now, of course, one of the benefits of listed standardized options is that they're fungible and they're very liquid. Flex options, not so much. You basically put that trade on and you keep it until expiration because you're going to have a lot of slippage getting in and out there on the bid ask because there's not a whole lot of liquidity providers willing to take the other side. So it has its advantages and its disadvantages. It's mostly for really big traders, probably institutional professionals, maybe really, really big non-professional traders too.
Yeah, if you're writing into a show like this, you're probably not ready for flex options. If you're doing your 10 lots and your 20 lots, flex options are not for you. They're customized contracts. Very, very meaty, usually very expensive to create, and like Dan said, very illiquid. So once you put them on, you're wearing them. So certainly not something you really need to worry about until you get to very, very advanced and very sizable levels of options trading. But a great question nonetheless, Mr. Nomad6, and thanks to everyone who wrote in. A lot of great questions. Keep them coming if you want to join your fellow listeners in the old mail call. Then, of course, you can do it a lot of different ways. You can post a comment or a question on the show notes of this program on the optionsinsider.com, and we'll route it to the appropriate show. You can find us on Twitter, twitter.com/options. Find us on Facebook, facebook.com/theoptionsinsider, or reach us the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put the name of the show you're writing your question to in the subject line so we can route it appropriately. And that is all the time we have for the mail call segment. It's also all the time we have for this episode of Options Bootcamp. But before we go, let me check in really quick with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Mr. P, now that you're back from the far, far exotic east, what is cooking in the land of market taker mentoring?
Well, I am ready to lift up the veil just a little bit on the new thing we have cooking here at Market Taker Mentoring. We are launching a brand new, state-of-the-art community for our traders. Many of you probably belong to chat rooms. I know a lot of people love them. Some people don't care about them. It's a great place to interact with other traders, get questions answered, get trade ideas. If you are a part of a chat room or ever have been, you look at them and you see that's basically 1993 technology. It's just crappy text. You've got to be pretty darn dedicated and, have a pretty low threshold for aesthetics by far to be able to deal with the just lousy design of most chat rooms. This is a state-of-the-art chat room that we're building. It spent a lot of time, a lot of money on designing it. It's going to be very modern, very useful, and very robust. So by the time this episode is live, I think our chat room is probably going to launch. So keep an eye out for that. Visit markettaker.com. We'll be sure to give you some information and let you know more about our chat room when it launches.
Just don't try to take the screen name Black Hat Dan, because that's already taken. I've already tried, so don't do it, listeners. All right, that's interesting stuff, Dan. I'm looking forward to seeing that launch. Hey, maybe we can pull some questions from there for the old show, too. A lot of great ways to keep the old interactivity flowing. All right, and last but certainly not least, Mr. Critchley, what is cooking in the land of SogoTrade.com?
Well, we are in the final touches or stages of a new advanced trading platform. It's going to have advanced charting capabilities, analytics. It's launching very soon. We're just trying to kind of figure out, dot the I's and cross the T's on some of the particulars on how we're going to present it to our customers. But, everyone stay tuned because I've been testing it myself. And even though I'm not a big fan of charts, if you are a chartist, the charting capability is really great. And, we're looking forward to maybe the next, few weeks or next month or two launching this. I don't know. We're not sure exactly the mechanism or how we're going to present to our customers, but it should be very exciting.
Well, check that out, listeners. And if you've been listening to the show all this time and you still haven't signed up over there at SogoTrade.com, if you still haven't kicked the tires, then do so right away. Surf on over to SogoTrade, SogoTrade.com, and check out all the stuff they have going on there, all their pricing, their virtual trading, and all these great new margin and charting tools that John's talking about here. A lot of great stuff to kick the tires with. Try it out in a virtual account, see if it works for you, and if it does, I think you're going to like what they have to offer over there on the ever-evolving SogoTrade platform. And on behalf of John and Dan and, of course, myself, I want to thank all of you out there for downloading and streaming and subscribing to this program and, of course, for writing in with such great questions. Keep them coming, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.